Welcome. Hello, and welcome to the Performance Leadership Learning Labs Virtual Roundtable. Exit Readiness starts with leadership readiness. We're glad you're here. Before we get started today, a couple quick housekeeping notes. A replay of today's session will be available for all registrants tomorrow. And if you have questions and you're joining us with the panel, please drop those questions in the chat. We'll actually leave some time for question and answering at the end of our session. So let us begin. We'll start with some introductions. I'm Will Gladhart, Chief Marketing Officer at the Culture Think Tank and the PL3, and I'll be your moderator today. So I'd like to ask each panelist to share a brief overview about their role and their background. Patrick, we'll start with you, then Bob, and then we'll wrap up with Will Lindstrom.
I am happy to do it, and I'm quite excited to be here. This one's been on my calendar for a while, so genuinely glad to be invited. I'm Patrick Morin. I'm a partner with Transact Capital Partners. We are an investment bank out of Richmond, Virginia, and roughly 2022 folks are with me here. You could tell by my deep Southern accent that I am not from Virginia. I am actually from a small town in upstate New York, right in the center of upstate New York. Former General Electric alumni, and then spent a couple of years down on the street. Came down to Richmond, Virginia, where we were able to build a pretty big REIT, real estate investment trust. Grew that to 30,000 units, and then we had an exit in 2005 to another, and then did various tech startups from there. And in 2012, while doing some turnarounds for private equity, I met up with my now retired partner and to join this investment bank where we do transactions in the lower middle and middle markets. So typically enterprise values of $20 million to $500, $600 million, right around that level. You know, along the way, I went back to school. I went to USC, the Gould School of Law. And then a little bit later on after that, because I didn't have enough punishment doing that, I decided to enroll in a doctoral program at Baylor University. And it sounds so much more glamorous than it actually is.
Well, I'm sure we'll get back around to that topic again today between both you and Will Lindstrom doing your doctoral studies. So, Bob, go ahead.
Thanks, Will. My name is Bob Dunn. I'm managing director with GF Data, which is owned by the Association for Corporate Growth and also a partner with PL3. What is GF Data? We believe GF Data is the best sort of source of valuation and other deal data within the middle for private equity-backed transactions within the middle market. We source our information from more than 300 private equity firms on a quarterly basis. Ask about 33 data points related to a deal covering, as mentioned before, valuation, also financial performance, the entire capital stack, cost of capital, and key deal terms as well. Business has been around since 2006. Our data set goes back to 2003. And again, the information that we provide is just not readily available. And we focus on companies with enterprise values between 10 million and 500 million, though we're shortly going to be launching a product focused on the small end of the middle market, 1 million to 25 million, that should be out in the fall, coming up soon. In terms of my background, I've been around, and it's around private equity since I started my career back in the late 90s as a journalist. At that time, everything that was happening was middle market because we were post savings and loan crisis, and there was not a lot of activity going on in the big end of the market. But it's great to be back in the middle market and really excited to be here for the podcast.
Well,
All right, my name is William Lindstrom, and I'm one of the co-founders and the CEO of the Culture Think Tank, and one of the partners at the PL3. And really what my background is always been in turnaround and consulting. So it's always about how do you analyze the data? How do you come up with the key metrics that drives growth and drives value? And at the PL3, I've partnered up with GF Data and others, and we're really working on SageForge, which is our product in the background, which is a SaaS-based platform to better prepare organizations and companies in the pre-due diligence stage so that they get better returns, better valuations, and more importantly, smoother transitions during the due diligence phase. So ultimately, what we do with our solution at SageForge is we're just measuring the leading indicators that are going to drive growth and speed to exit. And as Will alluded to, I am also finishing up my doctorate in leadership and learning in organizations with a focus on AI, really trying to focus on how do you take those qualitative metrics in leadership in the workplace, quantify them so that you have those indicators and those predictive metrics to know how what you're doing is connecting to the valuation you're going to get in the end.
Great. Well, thank you for those introductions. I'd like to begin with a couple thought-provoking questions. Patrick, we'll kick off with you. Going back to the doctoral angle here, how have your doctoral studies on cultural analytics shifted your approach to advising sellers and buyers in M&A?
So mine is a little bit different. It's funny because it's in the same vein as Will's, but it's a little bit different because I was studying specifically a different problem on that. If you think about any broad auction process or even a narrow auction, anything but a negotiated sale, what happens is that you go out, you find a bunch of buyers, you cull the herd, and you bring it down to usually 5 or 6 that are going to be coming into management presentations, MPs. And then effectively, buyers and sellers get about 3 hours to meet one another in each one of these meetings. Now, McKinsey years ago did a study, and they said that 85% of M&A fails to be accretive. And the corollary that goes along with that is that it's usually based on cultural issues, cultural mismatch, not because it was a bad strategy. It was just because when you brought the companies together, it was oil and water. So the premise of this is, especially in the lower middle markets and middle market, you usually have an earnout component that's going to be attached to the currency of a transaction. So that means that the performance of the company has to have an uptick in order to make sure that you're getting the maximum amount of value. And so you only have 3 hours to judge whether or not the there's going to be a fit before you have to pick the prom king, the prom queen to go with. And so it fundamentally comes down to what is happening in those meetings that indicate that there are cultural alignments between these two organizations. And the changes in the way that we advise them, it's not just about valuation of the company. It's not just about speed to close or surety of close. There also has to be that cultural fit in order to maximize the total valuation and the exit. And that changes the way that we advise folks. So that informed opinion is really what's been the difference.
And just to add in on what Patrick was saying there, in terms of the earnout frequency, we track that as a component of deals, and more than 50% of transactions, right around 50%, a little above, in the last few years have included an earnout component. Some of that has been driven by the sort of disconnect between seller expectations and buyer expectations. We were just talking before we got on this session that the market's been choppy since COVID. It's just been one thing after another with interest rates, and then now with what's going on with tariffs and some of the regulatory environment. But 2021 was a banner year for sellers, and I think there's still that expectation they can get that, and the earnout is really that component that goes into to kind of link the two together, as Patrick was saying.
Yeah, and you also know about it. It's also that shared risk model of yes, we have what you have. Whenever you're going to have a shared risk model, part of that risk has to be sent over to the seller. Right?
Yep, exactly.
Yeah, and just to touch on that, pretty much what we're focusing on is more upstream, which is actually how do you look at the qualitative metrics and the traits of the current leadership and the current organization, so that as you get to that mad dash and that final kind of decision, you have those qualitative metrics that are translated into quantitative metrics with predictive values, so you can actually get that better matchmaking. In some ways, it's almost like dating. We're trying to build up everything so you know exactly the profile of the company, feel very confident in it, so you get a better, faster, quicker transition, and you're not worried about your assets, the people, walking out the door.
Yeah.
Right.
Yeah, Will, I think you kind of touched on this a little bit as you kind of wrapped up that answer, but you often see culture and performance excellence as critical aspects of an acquisition. Can you share a little more from your experience what that means in kind of a pre-sale scenario and how those factors truly do impact the valuation?
So I think the biggest thing to take away is that there's no perfect leadership team. There's no perfect workplace traits. Every company is going to have their own subtlety to them. They're going to have their own culture to them. They're going to have their own aspects. But in the lower middle market, the most important thing that drives valuation is this fear that the leader, the founder, or the current leader that's stepping away is the business. Like, they have the relationships with the customers, they have the relationships with the suppliers, and them leaving is a big impact. And what I've learned from Bob is a lot of these organizations don't achieve, like 82% don't achieve their optimal valuation, in large part because that risk mitigation is being factored into the value. And so what really matters the most is to be able to demonstrate in this pre-due diligence process and have a very clear way for the outgoing co-founder leader to be able to demonstrate, look, here's the team that I have in place. Here are the relationships I have in place. I am no longer the business. I'm here to advise and support and help, but I'm no longer the business, and do that in a quantitative and qualitative measure so that the inbound strategic buyer private equity company has that confidence. And when you do that, and we've had a couple of case studies as we've been building it out, we're showing about an 18% increase in premium because you're able to demonstrate I'm not the business. And so therefore that risk mitigation is being folded back into the valuation.
Number one question that we get on the sell side is when private equity comes in, first they're putting a pin in the valuation. They're saying, here's the business, here's the geography, they got a kind of an idea on it, and they kind of pin, we think that we pay this multiple for this particular type of company. Right after they've pinned that, they go through 5 fundamentally risk factors that go at the end of it. And the number one of those is, what is the leadership team, not named CEO here? What does that team look like? And so Will's work in that space is critical.
Bob, any thoughts?
Yeah, I mean, I think this is an upcoming question, but exactly what we're talking about here, so you have the traditional areas of due diligence, financial, legal, environmental, et cetera. And a lot of that was, the financials were the focus, right? Like that was, coming out of an era when financial engineering was king. That was what people were looking at. How much debt can you put onto the books, et cetera? You can't do that anymore, right? So how do you offset the ability to lever up these companies? Well, you look at the operational side. So what's happening on that side? So diligence is taking longer, as I'm sure Patrick can attest to, and that's actually something that we're surveying on in terms of amount of time between letter of intent and close of transaction, but it's definitely been stretching out. Data site was reported at the beginning of the year in the first quarter. There was 8 additional days on average to diligence from the prior year. I think it's actually even more than that on it. Why is that happening? Well, there's more going on it, and it all comes back to what Patrick and Will were talking about on there. Coming out of the basis of what we call operational diligence on it, which has become a big focus for private equity over the last couple of years. Not just looking at the financials of the business, but actually looking at the systems and structures that are in place of the business. So is there a CRM? Is there effective use of marketing tools out there? Is there talent assessment going on, et cetera? Are these tools in place? And then once you get into it, a real focus on what the asset is, which is the people, right? Like, you generally are not buying a supply chain or a process. You're buying the people that built it and the people that maintain it and the people who will grow it in the future. And more importantly, on the private equity side or strategic buyer, you're going into a partnership with them in all likelihood that's going to last 3 to 5 years based upon the exit path of the portfolio company. Knowing what your leadership is, knowing the strengths of leadership, knowing what's missing in the leadership team can be essential on it. You're looking at a mad dash, and that first 90 days after close for private equity particularly is all important. So they want to be able to focus on what aspects of the business need work, what aspects of business aren't working, again, both operationally as well as talent on it. What is the morale? What's going on in the place? Are people excited about the transaction, or are they dreading it? Cultural assessment on it. Are we coming in and going to be viewed as invaders taking this over, or are we coming in as partners that are going to improve the business? And then ultimately, how all that fits together is scalability. Are all these factors working together, from the systems to the leadership to the people who are doing the work out there to the culture fitting right to actually hit that glide path and get a multiple upon the actual purchase price of the business at the time of sale when it ultimately sells again?
Man, I might even take that clip and snip it right there, and I might send just that statement. So anybody who's watching this or listening to this, I would take exactly what Bob had just said and call that gospel, because that's it. And I'll add an exclamation point to one part of that, which is diligence is not only taking longer, but it is also deeper.
Yep.
So sometimes there could have been a cursory look at something, but now it's not. Now it's a deep dive. They're going into margin by client, and they're doing it margin by client by month, right? So it's not just, oh, we looked at it. It's how much deeper. It's looking at the individual backgrounds of that leadership team. It's not just looking at the CRM, but what is the efficacy? Who's using it? What else is going on? So the depth of due diligence is significant, and that's also taking longer. It's no longer just a Q of E.
Yep. And interestingly, on that, we actually just started asking whether a sell side QOV was performed by the target company before. We only have 3/4 of data on this. It's a brand new question, but we did find about a half turn improvement in valuation if the seller conducts a sell side quality of earnings on it. What's that telling us? It tells us a couple of things on it. One, it tells us that the seller is prepared and ready for the transaction, and also tells us that the seller is looking at everything and wants to see the warts and fix the warts on the business before it gets to other folks' eyes. So again, it's that preparedness on it and being able, not coming in and as Patrick was saying, you get 3 hours in each of these sessions here. You don't get caught flat-footed at any point. If you've done the work, if you have a really good understanding of not only your company, not only your financials, which are kind of a given for it, but also your culture, also who are your stars, how are you qualifying those stars, how do they manage, what does the workforce think about them, what are the areas that you know need to be improved on, and what are you doing at that time? That's the sort of momentum from a manager or an owner that is really, really going to interest private equity at this point. And I think the same goes with strategic buyers, though it's about outside of my bailiwick.
No, it's actually, I'd love to have Will Lindstrom also chime into this, but part of that is, do you have an owner who's willing to do a sell side or founder willing to do a sell side QOV? Because that also sends another signal that we're confident. And
Yep.
the number of sell side QOVs that we're seeing the uptick is dramatic, and we're recommending it for most of the companies. It also makes it easier to sell, especially in the lower and middle market and down, when you might not necessarily have reviewed or audited financials. You might just have compiled financials. So it's worth the money. What's going to run you, depending on the size of the company, $30,000, $40,000. But even if you take a look at the half turn, whatever that number is going to be, you're going to get that money back very quickly.
Yeah,
No,
and it's an
and
investment in the business itself. Sorry, Will, but
no,
like,
that's okay. I was going to say, and that's
yeah,
literally what we're trying to focus on. But that's also where AI is now able to come in and really help
yeah,
in that capacity. Because before, having been in turnaround working with lots of systems, you're trying to bring all these systems in, you're trying to put all these ERP systems in just to be able to get to the numbers and everything
yeah.
else. But with AI now, so that's where I really see the evolution of this coming, is where AI can start to connect all the dots very quickly to make the pre-due diligence process set up the QVE, which then sets up the final due diligence process. Because when you have all three going together, it's going to increase the sense of trust and preparedness, and then it's just going to make the deep dive even easier.
And the ability
No,
to look at KPIs incrementally as well, Will, right? And I think, again, as you're ramping up toward a sale, being able to show on a biweekly basis how things have improved based upon the actions that you've taken to rectify some of those issues that you discovered, or just to continue to grow and scale. I mean, that's proactive, and I think that really excites a buyer. Sorry, Patrick, I think you're going to.
no, and it's also, if you think about it, you and I just stated that we're seeing the elongation of that due diligence
Yep.
portion. Sell side QOV can actually at least start to compress some of it, right? Because
Yep.
it's right in front. I don't think we'll ever go back to what it used to be, but I think that at least having that data up front gives everyone, it makes it easier for private equity and strategics to be able to buy a company, because they could look at it and say, all right, somebody's looked at it with some credibility. And I think it certainly helps in the negotiations, and I think that is the part that can be compressed. So great points.
Yeah, so I think since we're speaking about leadership exit readiness, Bob, thanks for covering some of those, more soft areas that are not just financial specific for leaders to be mindful of. Will Lindstrom, what leadership traits are most predictive of a smooth transition and successful post-sale performance?
So I think we've touched on this a little bit, and I know Cynthia would have provided a lot of good insights on it. And it's unfortunate she couldn't be here, because this is really her wheelhouse. But I think, having been coached by her, what she'll say is that there's no perfect leader, there's no perfect leadership traits. And what you're really looking for is to make sure that you have an alignment between the sellers and the buyers, so that there isn't this big cultural shift or this big attitude shift. Like, if you have a very family oriented, very collaborative type of environment, and then you have a very directive or dictatorial type, top-down type of, that's where you have those mismatches. And I think that's really where Patrick's focused on, is how do you accelerate that, or how do you have those leading indicators when you're in that 3-hour meeting to make that, even to bring that to light, so that you know that this may be a deal just worth walking away from, because as good as it is strategically, people wise, it's not going to work, or you need to readjust if you have operating partners or you have other people supporting, you got to remix that team to align for the incoming acquisition.
Yeah, and in this case, it really is the perfect is the enemy of the good in a lot of these cases. But then you start flipping it over. We've actually had on at least 3 occasions in the last 2 years where our sellers chose a lower offer, but a better cultural fit.
Oh,
And that, I got to tell you, that's enlightened leadership right there.
Yeah.
That is enlightened leadership, because it takes the self-interest out of just saying, yes, I'm going to get 10 million more if I go with these guys, but my company may not exist in its form in the next 3 or 4 years, or I might not get the second bite of the apple. And but that's a gut thing. That's where you're starting to see within leaders their ability to vet out the other people who are in the room and understand how they're going to interface with their own team that they know so well. But it's also a humbling thing, especially on the sell side.
Yep. And I think the mention of the operating partner and their role is a very interesting one. Definitely something that's become a lot more prevalent, right? Like, you have specialists now at private equity that come from industry backgrounds that are dedicated to working directly with portfolio companies, and they definitely have a point of view. But I think also, there's many different ways of having a point of view, and I think being able to suss that out and figuring out, what is your culture? What is the best, from the leadership all the way down to the talent below? How do people want to be led? What inspires them? And then do the suitors, share that vision on it? And I think that's what can really, and oftentimes, and what Patrick mentioned in terms of folks going with a lower offer, I hear that quite regularly also on it, that it wasn't a matter of top valuation. It was a matter of, you know, this seems like the right partnership. And again, I think you need to think partnership with private equity if you're going to go that direction on it, because you're going to be working very closely together. You're going to be changing your business also. It comes with the territory on it. It's a lot easier to do that when, hey, you know the business very well and you know what you need to work on and you know the potential there, but also that you're working with the right partner on it.
Yeah, it's funny. I had a conversation with a very good friend of mine, Dirk Wakeham, who's operating partner and a private equity investor with one of the big private equity firms in the United States. You'd know it if I said the name. But you take a guy like he, and you're able to parachute him into situation to advise, as a board member or other part of that. And then you take somebody who's the antithesis of that, somebody who's going to come in with that iron fist and the iron hand,
Yep.
and you start looking at it and saying, are you actually taking steps backwards versus taking steps forward when you go with the harder edged guy versus you
Yep.
go with the guy who's got industry credibility and who also can get the buy-in of those teams very rapidly to be able to say, have you thought about it this way? Are you moving in this direction? Can we go? And people rally around that. He's not supplanting the CEO. It's actually Merlin to the CEO, if you want to use that type of metaphor. And those operating partners are becoming a lot more important in making sure that those cultures blend.
Yep.
Yeah, I think
100%.
I think that dovetails well into kind of our next question, because you touched on it, Patrick. Is you've spoken about enlightened leaders? What's the biggest cultural leadership red flag that causes buyers to pull back or reprice a deal?
Yeah, it is there. It is a demand. It's not even a request. It's a demand that certain things must stay in place. It's back in the 70s, they were talking about sacred cows, right? But it is whether it's a name or policy or something, but it's also it comes out in the self-centeredness, the self-centric nature of the ask and how they're asking. And it really is indicative a lot of times of when they're talking about how it impacts them rather than how it impacts the company or how it impacts the team or some of the broader things. And it's sometimes it's subtle and sometimes it is waving the red flag and walking down the street. But you can see in the discussions about how they're talking about the people that have been loyal to them over years and where they are and where they hope to be, and how that leader refers to them, talks about them. And I will give you another thing, which is a red flag, is MPs. It's usually going to be 3 to 5 members of the selling team in that room. And if it is only the leader doing the talking, huge red flag.
Oh,
Yeah,
interesting.
agree 100%. It's the entire senior management team, right? Or at least the critical ones on it. And I think that, the company's not an I, it's a we. And I think that subtle distinction on it tells a big story on it. And definitely if it's the former, it's going to be a red flag going in on it. And also I think it's just that level of, I don't know, self-centeredness. It projects that it's going to be tough to change it. And the reality is, as you say, the definition of insanity is doing the same thing, expecting different results. If you go through a change in control, things are going to change. And it's just the nature of it, because the business needs to grow faster, because a new owner is coming into it. There's going to be changes to it. It's a matter of making sure that you're comfortable with those changes, and that will, in your mind, be the best pathway for the business to grow on it. But I think again that comes through in your uh, rapport with who you're talking to on the buy side, and that I think quite quickly you can sort of figure out in a 3 hour conversation, these are people I can work with, or these are people I can't. But it's a group discussion. It's not a one-on-one discussion.
By the way, I want to add something, and then because I know that Will's probably been in the same situation that I have, and I guarantee you have, Bob, which is during those hours, during those MPs, and even the run up ahead of them and behind them, you're always on stage. And I think a
Yeah.
lot of times founders and sellers forget about that, is that, you all happen to be in the men's room together, the women's room together. That
Yeah.
conversation matters. You're having lunch, that conversation matters. You're out in the hallway doing something, that conversation also matters.
Yep.
They see it. How you take a telephone call when you have to be able to walk out of the room, and what do you sound like when you've answered that call as you're walking out to handle it? There are such subtle things that go along with that says the person in front of us is a front, and it's a facade, and
Yep.
they're not really who they are. And on the flip side of that, if you cut them open and they're orange on the inside and orange on the outside, well, that's got some integrity, and that goes a long way. Well,
Yeah,
Yeah.
we've been looking at it as fakers and takers. So like there's the two types of on the, if you look at the personality traits that drive performance, there's the narcissistic one in the ocean model, and like that's the fakers and the takers. So the takers are pretty easy to identify, but the fakers are the ones that are most detrimental to the business, because they get so good at acting that they sneak you through, and then you end up in a different situation. But I do have one question for you guys, since I'm a little up higher in the pre-due diligence and you brought out the earnout. But how does, like in this finding an orange, someone who's an orange and an orange inside, but when you find a group of leaders or a leadership team, and then they do take a lower amount, does that affect the earnout, or does that, is that rewarded in the earnout, or is there any type of, I mean, beyond just making sure you have a good deal, but is there that value, it's maybe delayed valuation or delayed value, because you're basically saying, I'll demonstrate my worth.
I'm going to take a crack at it first, then I'll let
Yeah.
Bat clean up. Because he's got the data right in front of him. Mine is going to be more anecdotal. Uh, what it really gives, when you look at it on a dollar to dollar basis, it's not necessarily is what I would say. Okay. But when I look at it at all the non-quantitative, all the qualitative elements that go into the negotiation as well, I find that when you have that authenticity, that all the other asks that are made are more easily granted on both sides. And so it's like, okay, so I'll give you an example. We're doing a deal right now with private equity on a company that's pretty significant. Even Bob, you'd be astonished at the amount of cash that we're getting at close, along with the amount of deferred revenue that's guaranteed, right, relative to the earnout. But this has been a fantastic marriage of two companies. Culture was point number one, and then they went to valuation. Fortunately for us, we got a monster valuation and a really good culture. And our guys, realizing that they're first in the pool in this private equity fund, they realized that there's significant value in that rolled equity. And so they asked me to go back and see if I could get a little bit more for them. And I was told up front by the private equity firm, look, there's no more to be had right here. But the meetings went so well, they came back and they were just like, you know what, we're going to give them a little bit more. And it was because of those things that happened. Now, that happens to be economically viable, but there was other things for which we asked that were not that were not monetary, and the private equity firm said the same thing. Yeah, okay, we'll look at that. Yep, okay, we're good with that. We're good with that. We're good with that. And I think I hate to say, I hate to be trite and just say honey versus vinegar, but it really does come down to that. It does. Bob?
Yeah, no, I think that's exactly right. I think also, we have these discussions, and again, we I think conceptually think about the sale closing, the deal closing is the end of the process. Really, it's the beginning of the process, right? There's a transition there, and I think one of the other trends, increasingly, alignment of interest is a huge thing with private equity, right? So you will, give a little bit more potentially in terms of rollover equity on it. It says, especially if the seller is asking for more of it, hey, I'm going to be here, and I know I can hit what we're going for. I know I can hit the growth targets. I know I can manage this business. And I think that's a huge amount of confidence the private equity firm takes away from that. Now, no one likes giving up equity on it, but in that case, you're seeing that this is really a manager who wants to optimize it, is enthusiastic about it, and is willing to essentially take the risk on it that the second bite of the apple will be sweeter than the first. And quite often that works out that way. Flip side of it, look at earnouts. I mean, anecdotally, I hear about 50% of them end up in litigation. You want the other 50% that don't end up there, right? That no one's going to change, move the goalposts on you once you've gotten in. It does happen on it, but that again comes back to correct cultural fit, right partner, making the right assessment when you're going through and meeting with potential buyers on it. But I think, overall on it, that I think, it's a fair thing to ask a seller to say, okay, I have a 3-year plan. I think we can do this. I'm excited about it. Well, okay, put up or shut up. Put a little bit of money in or take that earnout on it, but have the right partner going into it to make sure that you do get the payout when you hit your goals.
Well stated.
Yeah, very good. So, we spoke about leadership, about culture, a variety of other topics. This question for everyone, but this might fall specifically to Will Lindstrom. How do you quantify culture as a performance asset or a value asset in a way that makes sense to investors, buyers, and operators?
That's what we're working on.
The $1 million question.
$1 million question. I think
There it is.
where it's coming down to our looking at the predictable behaviors. So there's been a lot of work done in performance management, turnaround, change management. So we know the behaviors that drive performance. There's just not that many. And you can think about them like leadership bottlenecks. Like, what are the leaderships doing that's bottlenecking or impacting performance? And so ultimately, where I think, and this is where the AI components come into play, is by being able to identify from the workforce. And it can't just be like, you leader, what do you think? It's got to be, okay, hey, workforce, what's the one thing your leader can continue doing, stop doing, start doing to help you be more effective? And then leverage that as not a Likert scale, not a number, but as just like open-ended text. What is it that you need? And they type that in and then allow the AI and the algorithm, that's what we're working on, to translate that into some type of an action plan that says, okay, you need to, and in some of our modeling, like remove red tape. Okay. And that now leads to the conversation of, do we actually have red tape? I didn't know we had red tape. What do you mean by that red tape? But now that's where you bring that synergy of the operating partner coming in, because you're just taking the mystery out of what needs to be done. And then it becomes how. And most leaders and most teams, when they know how, when they know what they need to do that's going to give you the biggest impact, the how becomes possible. And then they focus on the how. And then the last piece is you got to bring it back to the so what, which is, okay, so what did it do from KPI perspective, or so what did it do from a valuation perspective? But I think ultimately I think leaders, we know what the problems, we know what the problem areas are. It's identifying it what very quickly, and then putting the right people together to address the how, and then measuring the impact.
Great. Excellent. So one final question, and then we've got a couple questions from the audience for the panel, but this is for all. So, what's a practical step that you'd recommend for a wealth manager or fiduciary that they can take today to help their clients start de-risking their leadership transition or planning for sale?
Yeah, if you guys don't mind, I'm going to volunteer for this. I am on the phone with wealth managers every day. As a matter of fact, during this call just now, I had a wealth manager text me about a couple of her clients, right, that are thinking about going to exit on this. A couple of things. Whenever I'm talking to a founder, I'm always telling the founder, uh, you're effectively gonna need four people on your exit team. You're going to need an investment banker. Whether or not it's me or not is immaterial. You need somebody. There's got to be an intermediary because you have to have a Sherpa. You wouldn't try to go up Everest alone. Okay. You're going to need a deal-oriented attorney, definitely. And not the guy, your marital attorney, not the guy who got your kid out of trouble when he trespassed on a rope swing on a river.
Personal experience there?
For instance, right?
No, I just came up randomly with that one.
Okay.
You're going to need your accountant because they really own those books, and you're going to need a wealth manager because a lot of times we could send somebody 80, 100, $120 million and all of their wealth has been tied up in their company, and now they're realizing it. They're getting this liquidity event, and you can't just plop it onto a wealth manager and just say, here's the money, and they're like, whoa, I got to bleed this into the market. So now you invert that and you say, what can wealth managers actually do to be able to help that? That is that regular beat that has their founders, their clients understand the horizon and making sure that if you know that you're driving from, let's just say Richmond, Virginia, where I am, down to Orlando, you know what you're packing the car with, and you realize that you can get off at any exit to be able to get some of those assets that you need, gasoline or food or other things. It's the wealth manager's job to make sure that they know where the exit points are and how much fuel is left in the car, and whether or not they'd be able to need to refuel. And they can tell that by looking at even at industry averages and getting some ideas of their customers, if they're tracking their clients' businesses relative to benchmarks in the industry, and they know whether or not some of the wealth that's coming off of it is fueling it correctly. They are going to be able to, number one, at least have the realistic conversation with them. And then number two, wealth managers are disbelievingly plugged in to service providers, and they talk to them all the time, and they can vet out who the charlatans are and who the real ones are and point them in the right direction. It is a critical role.
Yeah, I would just add on it. I think, no one starts prepping their business early enough for it. And like you're looking at 2 to 3 years of prep in most cases. And I think, that's a conversation with the wealth manager and a business owner on it, right? It's not, hey, I want to sell my business tomorrow. It's having those longer conversations. When do you want to retire? Do you have a second generation that will take it over? If you don't, are you enjoying it? But having those conversations early on it so you can start to get your ducks in a row and, spend the time on the business. The other thing I would say, and we, hear about this all the time, you get into a sales process and the owner is all completely focused on the business and not focused on the sales process. You have to be focused on both. You can't lose sight of the business, but the sale process is the ultimate, fruition point of the company you've spent all your life building or however long you spend building it. And, it needs to be your primary focus when going through, and you need to be honest with yourself and put ego aside and say, where are the problems in this company? Because if you don't come up with it, the buyer during diligence definitely will. So I think starting early, prompting the client to start early on this, having those conversations about, what does the horizon look like, to use Patrick's analogy on it, but really just planning and knowing that this is not, it's not a short trip, it's a journey, right? And giving it the appropriate amount of attention.
Yeah.
Okay.
And before we go over to Will on that one,
Oh,
I want to be able to add to something you just made that was so smart. And that is you have to trust your advisors, all four of them.
Yes.
You have to trust them. This is, I said to a founder the other day, I said, you ready for the sales pitch? I said, this is going to be the worst experience of your whole life. It's
Yep.
emotional. It's got like, it's tough, right? You're going to say, should I do this? Should I not do this? And that level of emotion that goes along with being able to divest of your company, the fact that you got your personality tied up into it, your identity's tied up into it, you have to trust what your advisors are telling you. And whether or not it's coming from your attorney, your accountant, your investment banker, your wealth manager, if you don't have that level of comfort that this person is A, your gladiator, and two, is speaking truth to power and was telling you what you need to hear, not what you want to hear, then you need to change dates to the party and go get somebody else.
Yeah, and just to
Agreed.
touch on that, because you bring on the identity side, because that's what we're seeing is one of the biggest things that isn't addressed up front is everything else is, but what am I going to do when I quit? What am I going to do when I'm done?
Yep.
And oftentimes what happens is they get to that point of cavitation. And so they're in that 3 hour meeting, they're in that point, they're like, I can't. And that hesitation, that unwillingness or that desire to hang on a little bit longer falls right within one of our deal killers. And so it's not only trusting your wealth manager, but the wealth manager also needs to help figure out, back to the car analogy, is like, what's your off ramp from your own company and from your own and from where you and the company are one. Because if you can separate that, that's where you're going to get that valuation back, because that risk of you being the business is mitigated.
Correct.
So, well, just real quick, one of our guests had a question for Patrick. You'd mentioned a company that was culture first was the big portion. So can you share about the top performers that acquired that company, and what were they doing differently, or what made them unique?
Yeah. Oh man. It's funny because I was just on the phone with the buyers on Friday. And I actually told the buyers, it's the founder of that particular fund, I said, you are in the top three of private equity buyers that I have ever dealt with in my entire career. And he got really silent. And he said, really? And I said, I'm telling you, they are. And I named them. I said, number one, number two, number three. And you obviously you know where you rank now. And he said, why was that? And I said, it was the way that you did this. It was the way that you came across. You actually listened to the target. You actually listened to the CEO, listened to the teams. They took it in. They talked less. They listened more before they actually responded. They understood the motivations of each of the five. We had five members of the leadership team in the MP, and they had actually noted the desires, personal and professional, of each of the five, then wound them all together, and then brought in the company as a whole. So all of the objectives, individual objectives of the five were met, and then the objectives of the company as a whole were met. In due diligence, it was like a military action. It was ticked, tied, presented. We hit this timeline. If there was ever something that was going to go askew, we knew about it early. It was fast, that they were able to turn it around. And what my client realized was that the buyer operated exactly the way that they operated, and they did it by demonstration. And it was a remarkable thing to witness. And now that I'm thinking through this, the same thing happened to the other two of the top three, almost identical processes that I just described a moment ago. And I will also say this, there was a tremendous amount of rapport. And if you think about it, even within your own personal relationships, whenever you have, let's just take it with your girlfriend or your wife, right? Or, your significant other, whoever it is, whenever something gets at cross purposes, you have a choice. And the choice is what is about to come out of my mouth going to build this relationship, or is it going to tear it down? And when that, and depending on how much you care about that person, the situation, the deal, whatever else it is, to the point that you could default to, it's going to build this relationship, it's going to build this deal, even if you can't give them ultimately what you want. That level of rapport makes a huge difference.
That's very well put. It's a very well put.
Yeah, well, we don't have any other questions, so we'll wrap up today. So thank you so much for joining us. We hope the conversation helped illuminate how leadership readiness is changing the game in exit readiness. This roundtable is part of a monthly series from the Performance Leadership Learning Lab, where we explore topics like leadership, organizational performance, cultural alignment, and investor decision-making in greater depth. Next month's topic will focus on financial performance, so stay tuned for additional details. To learn more about us, visit www.pllab.com. We'll see you next time.